Hello, I'd like to talk to you today about the flat rate scheme for VAT. Now, this scheme was introduced a number of years ago and was designed to make the life of the small business owner much more straightforward when it came to accounting for VAT. And I think over the next couple of minutes I'll show you some of the advantages of the scheme. At the heart of the scheme are estimates which have been calculated by HMRC based on their analysis of VAT returns submitted over a number of years. As in all estimation systems, there will be winners and losers. HMRC are not taking many risks here, and it is only the smallest businesses that are eligible to join the scheme, with a turnover of less than £150,000. At each anniversary of the date of joining, you must do a review, and if the turnover has exceeded £230,000 in the last 12 months, you must exit the scheme. So you may be eligible to join the scheme, but do you want to? Well, the scheme certainly is a simpler way of accounting for VAT with a lot less regulation. If you're one of those traders that loses their purchase invoices, then this is probably a good scheme for you because you don't need the purchase invoices to justify the input tax reclaim. The VAT payment is calculated as a percentage of your gross turnover, and those percentages are published on the Revenue website. But you can still reclaim VAT on large capital expenses. So here's an example. The flat rate percentage for accountants is 14.5%. An accountant with a turnover of £20,000 would gross up that to £24,000 and apply the percentage of 14.5%, giving tax payable of £3,480. So what about these larger items costing £2,000 on which you can actually claim input tax? These might be single items such as a pickup. There could be a package of computer equipment, or there could be a range of equipment bought from a single supplier. But they have to be goods and not services. So leased assets don't count, but HP does. Building work doesn't count because that, for VAT purposes, is a service and not the supply of goods. A major drawback of the scheme is that turnover includes a lot of items that would not normally carry VAT. The level of turnover can be calculated either using the invoices you've raised or money received, but it does include all sales and receipts, including rents, lottery commissions and other exempt items. It doesn't include bank interest, and it doesn't include non-business items. Here's a simple test to see whether the flat rate scheme might be right for you. Take your last VAT return and calculate your box 5 figure as a percentage of the totals of box 1 and box 6, and then compare it to the revenue percentage. I did this calculation based on our own latest VAT return. Taking the box 5 figure as a percentage of box 1 and box 6 gave me 13.36% compared to the revenues figure of 14.5%, and so we would have paid more under the flat rate scheme than necessary. From this you will see that the scheme is not for everybody. It is only available to the smaller businesses. I would also add that this is a very brief outline and there is a lot more to the regulations, and so do get in touch.